Happy Friday, everyone. Thanks for tuning in to Business Daily. I'm Lee Ji-yoon in Seoul. Before we get started, let's take a quick look at today's highlights. People here in Korea are expected to be able to sign up for individual savings accounts or ISAs starting early next year, giving account holders a greater number of investment options. What's happening in global business news this week? The European Central Bank announces fresh stimulus efforts but falls short of meeting high investor expectations, while China plans to dramatically cut down on CO2 emissions by the year 2020. After next year's budget plan was passed at Korea's National Assembly earlier this week, the government released its first long-term outlook on government debt levels. Now, with the debt-to-GDP ratio set to hit the 40% mark for the first time in 2016, our Hwang Jae tells us what Korea expects in the coming decades.
Korea's public debt will exceed 60% of GDP in 2060 if the government fails to keep spending under control. The outlook coming from the finance ministry cites various structural issues that threaten the economy's long-term fiscal health.
Korea's population is aging at an unprecedented rate in the face of a low birth rate. This will raise welfare expenditures while the potential growth rate remains sluggish.
The figure is based on the scenario that government spending will keep pace with the country's nominal growth rate. The ministry adds, though, that Korea will be able to hold the level below 40% if it goes through a debt restructuring process. But with debt numbers expected to shoot up to over 40% next year for the first time ever, the government pledges to keep a close eye on possible risks for maintaining fiscal soundness.
We will regularly monitor possible risks that can hurt our fiscal health and come up with preemptive measures.
While adding that the core solution to the country's worsening fiscal health is maintaining a stable growth rate, the government says the 60% rate of debt to GDP is still far below the OECD average of 115% forecast for 2016. Hwang Jae, Business Daily.
Meanwhile, inflation has remained fairly flat in Korea throughout this year, staying below the 1% mark until November. But for those of you out grocery shopping, price growth may not have seemed so tepid. According to Statistics Korea, the price of agricultural meat products started to increase rapidly in May due to a severe drought. Over the following 3 months, the price of these products jumped by around 3 to 4% each month. Some of the products that saw the largest price gains were cabbages, which surged 90% in June, and onions, which cost nearly double in November. The price of Korea's Hanu beef and pork also rose, facing a shortage in supply with less cattle being reared. Following the passage of a number of finance-related bills at Korea's National Assembly, discussion is ripe for the introduction of a comprehensive savings account. Now, this all-in-one account allows holders to manage a number of financial products and is expected to trigger a shift in the finance market. Our Shin Se-min explains.
All of your investments in stocks, funds, and derivatives, and savings in one account at lower tax rates. The individual savings account, or the ISA, allows people to manage all of that under just one account. It's a new scheme that offers those outside of lucrative investment circles the chance to pile up financial assets at lower tax rates in hopes of creating an extra sum of wealth worth $470 million according to government estimates. It's a plan that comes with better profitability compared to other existing financial products, and only average income earners will be allowed to open an account. Following the expiration of a 5-year savings plan, or 3 for young Koreans or those with low incomes, the holder will be exempt from capital gains tax, enabling them to amass a good chunk of money. The tax-free limit for the ISA approved by the National Assembly was some $2,100, up $400 from the amount initially proposed by the Finance Ministry. But despite these benefits, experts say the cap was set at too low a range to produce more effective results.
In countries like Japan and the UK, their ISA tax-free limit reaches up to $8,000 or $25,000 per year, respectively, meaning that the amount approved by the government is too little to sufficiently benefit account holders.
Securities firms still anticipate a new group of customers will jump ship as they believe the trend of low interest rates will help attract new account holders. But experts advise those interested in ISAs should consider factors like the amount of disposable income, the purpose of investment, and individual investment tendencies when opening this new account. 신세민, Business Daily.
Ever since the government passed a law to improve regional balance within Korea, more than 150 public institutions have been relocated to smaller cities across the nation over the past 10 years. Our Lee Ju-young takes us to one particular city and looks at the changes.
This is Naju City in Jeollanam-do Province. With new roads and buildings decorating an urban landscape, it's hard to believe that just 10 years ago, the area was far from being developed. The change is largely due to a law passed back in November 2006 that pledged to create a more balanced growth throughout the nation. Since then, over 150 public institutions that were in Seoul have been relocated to 10 smaller cities around the country. In Naju's case, the relocation of the nation's biggest utility firm, Korea Electric Power Corporation, along with 13 other public entities, has helped the city transform into a place that now boasts over 11,000 in population, up nearly fourfold from previous numbers. The employment rate here is also the 5th highest in Korea. The utility giant said it hopes to attract 500 energy-related firms to the city by 2020 to create a so-called energy valley.
Conglomerates, mid-sized companies, and research centers related to the energy sector can all gather here and gain a competitive edge that will help us branch out globally.
While experts agree that substantial development has been made in these cities over the years, an interim report by Korea Research Institute for Human Settlement revealed that over half of the monthly expenses from employees were spent outside of the city due to a lack of educational and leisure facilities for their families. Experts add that if overall living conditions do not improve in these areas, the drive to revitalize smaller regional economies will only produce half the desired effect. Lee Ju-young, Business Daily.
It's Friday, and that means it's time to look through some of the global economic headlines from this week. With that, we're joined by our Eunice Kim in the studio. Hello, Eunice.
Hi.
All right, so overnight, the European Central Bank announced some changes to its quantitative easing program, namely an expansion.
Right.
But then I heard it wasn't really well received by investors.
Right. So the European bond buying program that it would expand was not a big surprise, but it seems investors were expecting much deeper revisions in terms of stimulus, judging from the market movements we saw on Thursday. Take a look.
Indices across the Atlantic were seeing red on Thursday's trading day as the euro swung up 3% against the greenback. Germany's export-heavy DAX for a time plummeted by more than 3%, while the Euro First 300 index clocked its worst performance since August by the day's end. It was more of the same over in New York. All 10 S&P 500 sectors registered losses, pushing the bourse back into negative territory following its biggest drop since September. All signs of disappointment following a much-anticipated announcement by this man, Mario Draghi, the president of the Eurozone's central bank.
The monthly purchases of 60 billion euros under the asset purchase program are now intended to run until the end of March 2017 or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its aim of achieving inflation rates below but close to 2% over the medium term.
The new package would extend Europe's bond buying program by another 6 months at the current rate, while the program itself was expanded by at least $390 billion. Deposit rates were pushed further into negative territory by 10 basis points, or 10 basis points short of what investors were expecting, as the Governing Council wanted to keep more tools in the shed in case deflation risks and outside shocks called for more aggressive measures.
Our asset purchase program is flexible. We can always adjust its horizon, its size, its design. And we are not going to be, I would say, hampered in doing this by technical issues. As a matter of fact, we are going to revisit or review some of the technical parameters of our program in the spring.
So these measures weren't just enough to meet those lofty expectations. But how does the ECB and Mario Draghi view European growth going forward?
Well, for one, they're expecting that it will take longer to reach their inflation target of 2%. The central bank did publish forecasts that showed inflation this year will only come in at 0.1%, followed by 1% next year and 1.6% in 2017. But ECB President Mario Draghi said the European economy, despite its recent setbacks, is improving, and that this latest package of measures would reinforce the momentum. In fact, the Eurozone did log a 1.6% growth in the third quarter, with business activity last month quickening to its fastest pace since the middle of 2011.
And this week really has been quite unprecedented in what we had the heads of two central banks, right? In Europe and in the U.S., Janet Yellen.
Yeah.
They announced the changes to their respective monetary policies.
Right. And we did hear from Janet Yellen again on Thursday, U.S. time. This time she was before a congressional committee hearing where she reiterated her confidence towards achieving a 2% inflation target in the U.S. Let's take a listen.
I currently judge that U.S. economic growth is likely to be sufficient over the next year or two to result in further improvement in the labor market.
Yellen went on to dictate a jobs target policymakers were watching for ahead of a key jobs report to be released later on this Friday. She said that minimum figure is 100,000 jobs per month to cover those freshly entering the labor force. And you will remember that October we saw an impressive 271,000 jobs added. Meeting the criteria would further bolster the expectation that the Fed will move to raise interest rates in December, estimated to begin at 25 basis points.
And meanwhile, over in Paris, the UN Climate Change Summit is wrapping up its first of 2 weeks of meetings. And there, I heard that China made some strong commitments.
Yeah, you're right. So as the participating 150 heads of state and their delegates are putting their heads together to find a solution to climate change, we did hear from China's cabinet making a commitment to cut emissions of major pollutants out of its power sector by 60% in the next 5 years. A post on the official People's Daily website went on to say for carbon dioxide emissions, China will aim to trim 180 million tons annually out of its coal-based power plants by the same target year, 2020. Now, that is the year government think tanks believe Chinese power stations' coal consumption will peak. Meanwhile, a study by global organization Oxfam concluded that half of the globe's carbon emissions were created by the richest 10%, with their lifestyle choices that include buying a plethora of products, as well as heating or cooling larger homes and multiple vehicles, just to name a few examples there. Oxfam said the focus of the climate change talks should shift to the richest countries and their choices that impact the poorest half of the world, disproportionately hit with the impacts of natural disasters. And finally, over to Japan, where auto giant Honda has announced it will up its retirement age from the current 60 to 65 next year, amid national concerns linked to Japan's aging workforce and shrinking population. Currently, Honda can re-employ workers for 5 years post-retirement, but at a wage that's 50% of their previous salary. Under the new plan from 2016, elderly employees would take home about 80% of their base pay. Other notable plans include introducing a work-from-home arrangement as well as a partial workday system in line with Prime Minister Shinzo Abe's push to expand work options for women. Japan's already super-aged society is graying even more, with over 10 million of its citizens turning 80 years or older this year. Tokyo has said it will push back the starting point for pension distribution to age 65 from 61 come year 2025.
And of course, Korea is no exception to this aging society.
That's right.
All right, thank you so much for coming in today, Eunice.
You bet.
And that wraps it up for today and this week. Thanks so much for watching, and we'll be back next week with more business news that matters to you. Have a great weekend, everyone.